Okay, shall we start? Hope everyone can hear me. Okay. Okay, so what we started last week is the P&L and the balance sheets, that the financial ratios, right? I just get the P&L. Can you see the code? Is it visible? Is the board visible to you? If I write here, is it visible? Not yet? This one you can't see?
Sir, if you can move the board bit forward, then it will be easier for us to see.
Now?
Yes, sir. Yes.
Okay. So, turnover, direct cost, raw material, labor, power. It can be electricity, whatever, generator, power, anything. Then we have gross profit, overheads, admin, selling, finance, profit before interest and depreciation, interest, depreciation, operating profit, other income, you can see that, profit before tax, tax, and profit after tax, right? This is the entire P&L. So, turnover equals price into quantity. Okay. So, it can be several products and several different prices. Sum of price into quantity. N equal 1 to capital N. Right? You can have a mix of products like washing machines, TVs, electric items, like that. You can have different products. Right? Any cost which changes with the units sold, number of units sold, is called a direct cost. Right? Raw material, labor, and power we consider as the main direct cost. Where any cost which does not have a direct link to the quantity you sell, we call it as overheads, right? Like manager's salary does not have a bearing on the number of units we sell, right? Rent expense does not have a bearing for the units we sell. Any payment done to the banks except for interest comes here. All the interest, long-term, short-term interest comes here, right? Then depreciation for your fixed assets. Other income, that is the income generated not from the main business. Like if you are operating a printing shop, income generated through printing comes here. But if you sell the offcuts and all those things, it comes here. If you are a manufacturer of shirts, sale of shirts comes here. Sale of offcuts, waste material, those things comes here, right? Which is generated not from the main line of business. Then you have profit before tax, then tax and after tax. You can just stop it saying net profit here, right? So, similarly, you have the balance sheet. You can see this part. Okay. Balance sheet, you have fixed assets. Any asset which has a useful life more than 12 months is a fixed asset, right? We have land, building, machinery, vehicles, like that. We have different fixed assets. We have the gross fixed assets, which is all these are at the cost. Then less accumulated depreciation. That means this is the depreciation for the specific year, right? Year on year depreciation accumulated and reduced from your gross fixed asset. Then you have the net fixed assets, right? Then you have your investment. I'm writing a little smaller. Can you read it and see it?
The board is not clear.
It's not clear. This is clear. For all others, it is not clear.
Now it's like blinking. Now it's clear. Now clear.
Okay, maybe some problem with the camera. I didn't do anything. Right? Okay, so you can read this because I have written it a little smaller. Can you read this? Can you read these letters?
Can read, sir.
Okay. Right? That means any like FDs you can place more than 12 months investment, right? Then your current assets, mainly inventory or stocks. This has to be the trading inventory. If you are fridge seller, number of fridges you have. Then you have debtors, cash. We have two ways of writing a balance sheet. I use this one for a purpose, but you can have it other way as well. Current liabilities, right? Current liabilities, it is creditors and ODs and short-term facilities. Net current assets or net current liabilities. Then you have total assets. And if we take this as A, this as B, This is C. This is D equals B minus C. E equals D plus A. Right? This is the total assets. Then we can have finance by portion, where it is share capital reserves, net worth, term loans and leases, total capital employed, right? This is E, this is F, G, H equals F plus G, right? Then E should be equal to H, right? So in this, any asset which has a useful life, we'll write as the fixed asset. Any asset which can be converted to cash within 12 months period, we term as current assets. Out of the current assets, inventory is the hardest to convert to cash. So it is written near to fixed assets, almost fixed assets, right? Like it is from the hardest to convert to cash, it comes down liquidity wise, right? Then you have creditors. This is current liabilities. The any liability which needs to be settled within 12 months period, we write up under current liability. Current assets minus current liabilities is the net current assets, so net current liability. Again, we call it the working capital. Then fixed assets. Sorry, there's another one. Fixed assets plus investment plus net current asset current liabilities is the total assets in the business. Finance by part, you have share capital, that's the owner's funds. If it is a sole proprietorship, owner's funds. If it is a partnership, it is partner's capital. If it is a limited liability company, it is share capital. Then we have reserves. Reserve is the point, balance sheet and the P&L is linked. Balance sheet and the P&L is linked through reserves. Profit carried forward for the next year, right? Then adding these two, we call net worth. The word net worth is used only for the profit limited liability companies, right? Then any liability which needs to be settled over 12 months period, it is a term loan, leases, that kind, we marked it here. So net worth plus long-term liabilities is the total capital. Total capital should be equal to total assets, right? That is this one. Again, this part, which is net worth, is called equity capital. This part is called debt capital, right? Then balance sheet is linked to the cash flow from cash position of the balance sheet, right? So this is the P&L and the balance sheet. There is another way of writing balance sheets, that is fixed assets, current assets, total assets, current liabilities, net worth, long-term liabilities, total liabilities. This should be equal to this, right? So they can ask any, we can write this way or we can write this way. I have written this near to each other, so it is the working capital. Otherwise, it is two different places, right? Whether you get this format or this format, that's the same thing. P&L is for a year. Balance sheet is for asset date, right? This is the financial performance of a company. This is the financial position of a company, right? Who requires this? P&L and balance sheet financial positions, who require? Internal people like managers, owners, they require this for planning purposes and controlling purposes, whereas investors, rating agencies, departments, tax departments, they need this for the evaluation purpose of the company, right? So before coming back to this, we'll go to the presentation.
So balance sheet shows the financial position of the company, and the P&L shows what?
Performance of the company, right? How the company has been performed. Okay.
Okay, sir.
Say this one. Financial position of the company, and this is the performance of the company, right? Then okay, you can see the screen now. Financial statement analysis is evaluating these all items. Who requires is internal users and external users. Investors, creators, regulating agencies, stock markets, and those things are the external user examples, and internal users are the management. You just go through this. There's not much. This is an important thing. When you read financial statements, you have to read it with the notes, right? We should get the notes, otherwise these are just snapshots. Details are given in the notes. Always get the notes when you are reading a finance. Then letters to the stockholders and auditor report. That is a very key, important document. If auditor says we qualify, can I know whether it is a good sign or a bad sign? auditor qualifies the account. Who are for good, who are for bad? One bad. Only one? What about others? Hurry up, hurry up. Two bad. Three bad. Okay, four bad, right? Yeah, it's bad. Qualifying means they are reserving their comments. They are not entirely happy with the accounts. Normally, when we say qualified, that's a good sign. But when the auditor says we are qualifying, we are signing under this qualifying statement, that's a bad indication, right? So these things should be accompanying the P&L and the balance sheet. These, okay. Now we'll go to analysis. This. Right. We have several methods of analyzing. First one is horizontal. That means we have year 1, year 2, turnover X, Y, right? We are analyzing a single statement item across 2 years. That is horizontal analysis. We are comparing what is the percentage growth, what is the absolute growth, and why. That kind of analysis is happening. So that is a horizontal analysis, right? Then we have vertical analysis. That means all these items are represented as a percentage of a major item, right? So we evaluate vertically, right? Gross profit is 10% of turnover. Raw material is 3% of turnover. Like that, we evaluate vertically, right? That is vertical analysis. Then we have trend percentage analysis, right? That means here we took only 2 years, but under trend percentage, one single item will be checked for 5, 6, 7 years. Long period, how the turnover has changed in this company, how the cost pattern has changed in this company. That's called trend percentage analysis, right? Then we have ratio analysis. We have different ratios to be calculated. We will analyze those ratios and interpret those ratios. Then you have common size financial statement, common size. That means in a normal financial statement, all the figures are given in absolute terms, rupees million, rupees thousands, or rupees. But under the common size, no absolute terms, only percentage terms. Like turnover is 100%. Everything will be represented as a percentage to the turnover. Fixed asset, total assets is 100%. Everything is represented based on total assets as a percentage. Why we are doing that? That is to get rid of the size of the business. Like you have Unilever, which has a trillion rupee income. We have another soap manufacturer which has some millions. So you can't compare in absolute terms how efficient, which company is efficient. But if you put it on a percentage terms, you can compare it because it is only percentage. Volume and the rupee value does not matter. But is the gross profit margin as a percentage of turnover. Unilever may be 20%. That other small company may be 30%. So efficiency would be better in the smaller company. Like that. So it is common size financial statements. Right? This one, using comparative financial statements to calculate rupee or percentage changes in a financial statement item from one period to the next. That's 2 periods we are looking at. Vertical, for single financial statement, each item is expressed as a percentage of a significant total. All income statement items are expressed as a percentage of sales. Common size financial statement that shows only percentages and no absolute rupee amounts. Trend shows changes over time in given financial statement item. Can evaluate financial event several years. Ratio analysis. Right. We'll take examples. The management of this company. This is a financial statement given. Horizontal analysis happens like this. Rupee change equal current year minus base year. This is the current year. 2019 is the current year. 2018 is the base year. Right? Percentage, that is the current rupee change. If it is percentage change, that rupee change divided by the base year figures. This is the example. 2019 cash position is 12,000, whereas 2018 23,000. So it is a negative change, right? 11,500 negative. If it is the percentage, it is 11,500 divided by 23,500 is the base year figure. Right? So it is negative 48.9%. So that is, we are evaluating same item between 2 periods. Right? How it has changed in absolute terms and percentage terms. So you can do that for all the items. This is the equity side. So we don't need to waste time. That's the method we are doing. P&L also the same. See this one, net sales 590 to 480. So 40,000 increase, which is as a percentage, this is 8.3% increase. 40 divided by 480, so it is 8.3. Cost of goods sold, that also 45,000 increase, which is 14.3. Right? When you are evaluating it, though we have a net sales of 8.3% growth, net income has come down by 21.9. So the question can be, why even after the turnover growth, why the profit has come down by 21.9, right? So your answer should be, in that kind of a scenario, sales has increased by 8.3% only, whereas the cost of goods has gone up by 14.3, right? Then operating expenses has gone up by 2.1. Net interest expenses has come down. Because of these increases, your profit has come down. The volume is higher in these cases. See, 40,000, here negative 5,000, negative 2.6 thousand, like that. Similarly, here, vertical analysis, the management, see this one. So it is cash 82,000 divided by 483,000, 17%. Earlier it was 8%, now it is 17%. 30 divided by 387, right? Similarly, you can put it to any 82 divided by 4 is 17, 30 divided by 8%. This is the vertical analysis. So you can put it to it. Then you have the trend percentage analysis. Right? This is your base year. From the base year, what is the change? Right? So how you calculate that is this minus this one. If you want a percentage, this minus this one divided by the base year figure, that is this. Similarly, you do it for the other years also from base year, how it has changed. So when you do something like that, this thing increases like this, right? This is the trend. This is the trend. So it can say, if you do it for sales, this was the trend, and if it is for the expenses, this is the trend. So that is trend analysis. When you talk about the ratio analysis, we can represent the ratios in 3 ways. You can write the ratio as a 1:2 for each rupee, 2 rupees of the other item. Or you can have it as a percentage like this, or you can have a rupee ratio, which is normally used for the market ratio. This is the more common, more day-to-day use one. This is only for the market ratio, which are calculated for the listed companies, right? Using ratios and percentages without considering underlying costs is incorrect conclusion. The underlying reasons, if we use the ratios, that is a mistake. That will bring you wrong decisions. We have 4 types of ratios: liquidity ratios, equity or the solvency ratios, profitability test, and market ratios. Right? We have liquidity ratios. All the ratios calculated using current assets and current liabilities, those are liquidity. Day-to-day funds, right? Working capital, that is liquidity. Liquidity is the funding requirement for the day-to-day operations of the business. That is the working capital. So when you are calculating liquidity ratios, you use this one, right? Then you have solvency ratios. Solvency ratios is to do with finance, long-term funding part, right? Profitability ratios are to do with P&L. All the gross profit margin, net profit margin, ROE, all those things. Whenever it says profitability ratios, it is something to do with the P&L. Liquidity ratios, it is something to do with current assets and current liabilities. Solvency ratios is something to do with the long-term ratios. Then you have market test, which is derived from these two, but we are not calculating that for the normal companies. It is only for listed companies, right? These are the 10 ratios we will be working out now, right? So we will work out these figures. Before going there, if I'm not clear, please ask me, right? I just want to explain some more on the P&L and the balance sheets. Say, turnover is derived from price and quantity. We have something called you can't see that. Terms of trade, TOT, right? Turnover or sales, how it happens. You sell on credit, you sell on cash. Credit, you sell on post-dated checks, you sell on bill to bill. On top, on credit, you give a period of 30 days or whatever. So this part is called terms of trade. So when you are calculating any ratios, you should know this. At least what is the percentage of credit sales, what is the percentage of cash sales, and what is the credit period on average they are giving, right? Even if you don't have the breakup of this. What do you mean by bill to bill? Right? What do you mean by bill to bill? Anyone who has an idea? What has happened to you? Right, that's good. Pending one bill of payment. Yes. Like I go to a shop, give the customer goods, but he won't pay or he won't give me a check. I get his signature on my bill book, come back, go after 2 weeks or 3 weeks, collect the money for the previous bill and give another set of goods. So always there is one bill pending from the customer. That is very risky. When you go to the shop next time, if the shop is closed, you can't do anything because this is not a legal instrument. But if you take a check, it is a legal instrument. You can sue the customer based on this check, right? So post-dated check means any check which is written dated future, right? So this is the terms of trade. Other thing is, when you are calculating any ratio using P&L and the balance sheet figures, like you can calculate ratios using P&L figure only or balance sheet figure only. But if you are using preparing a ratio using both figures from both the statements, all the P&L figures can be taken as it is. But balance sheet figures you need to take as a average, right? Why? P&L is for a year, for the year I have written earlier, for a year, but balance sheet is for a day, as at day, right? So in order to get rid of this difference in timing difference, we get average figures from the balance sheet and same figures from the P&L, because it is for a year, that is for a day. So we take the opening figure and the closing figure and divide by 2, we take the average figure from this, right? That is another thing I want to tell you before starting. Terms of trade, then average figures and the same figures from P&L. Then when you are evaluating some, like the point is gross profit, right? We say gross profit margin is 10%. How do you calculate gross profit margin? GP divided by turnover into 100. That is the gross profit margin, right? When you are evaluating year 1, you can see that. When you are evaluating year 1 and year 2, right? When you are evaluating few years, this gross profit margin will change in a very narrow margin, right? It will not change like this. It will not change like, if it is 10%, it may go to 9 or it may go to 11, but it will not go to 5 and 15. That kind of a narrow band, it will not change. Why? Why is that? That is because any change in these 3 items can be passed to the customer from price. Why is that? When raw material price changes or labor price changes or power price changes, it will affect the entire population of production. Like if it is we see a bakery, if the price of flour increases, it will affect all the bakery owners. So everyone will have to decide whether to pass it to the customer or bear it, right? But if my rent cost has increased, that is my problem, not the problem of everyone. So I can't pass any cost increase in these lines to customers, but these lines I can pass. So therefore, whenever there is a increase in this part, we increase the price and pass to the customer. As a result, gross profit changes very narrow margin. It will not change in larger margins, right? This is wrong. So be mindful about it. I've seen people talking about gross profit margins, but no idea what is happening, right? Okay. Then our first ratio is working capital, right? Working capital is, I'll take the screen. So first ratio is working capital. Working capital is current assets minus current liabilities is called working capital, right? This comes as a rupee value. Go to the handout. Working capital, the excess of current assets over current liabilities. Current assets is 85,000 and current liabilities 42,000. So working capital is for 23,000. It gives us figures. It is the liquidity position we have. Then we talk about current ratio, which is equal to current assets divided by current liabilities, right? Total current assets divided by current liabilities, which is current ratio. What does this mean? And who used this ratio? Current liability holders like creditors, short-term lenders use this ratio. What we say, we have fixed assets, current liabilities, net current assets or net current liabilities, total asset, right? The theory is we settle current liabilities by liquidating current assets. We settle current liabilities by liquidating current assets. Right? I'm here. So this one. We sell inventory and create debtors. Then we collect debtors and collect cash. Then we will settle the creditors. Then we will settle the TODs. Right? It is not from the profitability. The capital of current assets and current liabilities, capital of current liabilities always settle by liquidating these. Only the interest is charged to the P&L. Right? So current liabilities are settled.
Can you repeat it again?
Yes. Current liabilities are settled by liquidating current assets. Inventory will be sold, debtors will be created, debtors will be collected, so cash will improve. That cash will be used to creditors and OD settlement. It is not from the profitability we are settling current liabilities. Current liabilities will be settled by liquidating current assets, because when you settle a current liability, you can retake it. So no issue by settling, liquidating this and settling this, because again you can take this and create this. Once you settle a creditor, you can get credit from the market, so your inventory goes up. Inventory is threefold: raw material, work in progress, and finished goods. When we are doing the working capital, we will look at it. Right? Clear?
Clear, sir.
Okay. Right. So this is the current. Okay, I was talking about the current ratio. Current ratio is this: current assets divided by current liability. Who is bothered about current ratio? The current liability holders. are worried about the current ratio. Why? This ratio shows you what is the coverage the current liability holders has from the current assets. The reason is that current liabilities will settle by liquidating current assets. So the cover, if we say current assets is 100 and this is 75, which is equal to 1.3. There's another case where 100 divided by 50, which is 2 times. If you are a current liability holder to this company, creditor to this company, which ratio you feel comfortable? First one or the second one? 1.3 or the 2? Can I know which one is comfortable to you? One answer. Two people answered. Right. Why? Because you know there is a comfort. Even if we can't liquidate part of the assets or we can't collect some amount of debtors, still we have enough money to settle the liabilities, current liabilities. So current ratio indicates the ability to settle the current liabilities by liquidating current assets. What is the coverage you have? Then the second one, is quick ratio or acid test. Right?
So what is the answer for the question? Two, no? Second
Two is the
ratio, no?
answer. Yeah. When you have a higher coverage, that is the better one. Right? But I will explain once I finish this. Right? Answer is 2. Out of 1.3 and 2, 2 is the answer. Right? Acid test is current assets minus inventory divided by current liabilities. That means inventory is the most difficult item to convert to cash. So what we do, we reduce the current assets amount and see the coverage. If it is approximately near 1, around 1, we are above 1, we are happy. Right? That means even without current inventory, we have a coverage for current liabilities. Right? If the question gives like debtors, details, debtors, marketable securities, note collectible, cash, like that current assets, then you take all these things and divided by current liabilities. Then if you have the details, don't just take current assets minus current liabilities, but take these things, these items separately and divided by current liabilities. These are the more liquid items, right? Quick assets. This should be above 1. Current ratio should be above at least 2, right? In the range of 2. If you have a current ratio which is around 4, is it a good sign or a bad sign? Is it a good sign or a bad sign? Thank you, Dita. Malaka, thank you. Yes, it is a bad sign. Why is bad? Why is it bad? Why is bad? Because this one, creditors, you can see the board, right? Current assets is a day-to-day operation, day-to-day funding, right? So you need current assets to run the business. But if you have a chance of getting and using others' money, right, you should use that than just pumping your money into the system. So you should get the creditors. But if the creditors are coming at a cost, then no point getting creditors. If it is not with the additional cost, it is better to get credit from the market because you are not using your funds. Your funds is the most expensive thing. You are buying raw material, but if you pay cash, it is 100 rupees a kilo. If you are taking a credit, it is 125. Then no point buying that. You better use your cash, use your finance, short-term financing. Because rates are low. You have to compare whether it is better to buy from your own funds or through a facility from a bank or from credit. If the normally creditors won't add a premium for a shorter credit period. But if it is 3-4 months, you will have a premium added. So you have to calculate that. So current ratio should be in the range of 2, whereas quick ratio in the range of above 1 is a better one. Right? Clear? Current ratio and quick ratio. Current ratio is calculated to find out the coverage of current liabilities. That is the coverage current liability holders have from the current assets. Why? Current liabilities are settled by liquidating current assets. Right? Then current ratio should be in the range of 2, around 2, maybe 1.9, 2.2, that's fine. But if it is lot more than 2, that is not a good sign of management. Because when you are using your own funds, your cost is high. You can use for more productive enhancements. Because you just build stocks. It is not worth. When you need to maintain the minimum levels here. By adding current assets does not give you money. Right? Inventory should be converted to sale fast. Credit sales should be collected fast. Then only you have money. Like increase in this and this is not very good signs. Increase in this is the best side because liquidity is with the cash. You can have lot of stocks, but selling takes longer period. Then you are just holding your cash in stocks. So that is not worth. Always you should try to maintain the minimum stocks and convert whatever the stock you have to sales faster. Faster you convert, more efficient you are. Once you convert to sales, you need to collect it faster. That means no point having sales. I can sell anything if I give a 6 months credit period. But you are just wasting your money. If you can sell 1/3 of that with a 1 month or 14 days credit, you can faster turn around your cash. Right? So your aim should be to maintain the minimum stocks and convert it to sales and collect the sales faster so you have cash to play around. Your creditors and the OD should be used. Facilities should be used without adding additional cost to the business. Right? That is why current ratio should be in the range of 2 and quick ratio should be in the range of 1. It is quick ratio is better when it is going up. Current liability holders would be much happier because we are not bothered about equity inventory, that is the other liquid items. Is it clear? Liquidity ratios. Any questions on that before I go to the other part? Need answer, yes, no, whatever.
Understood, sir.
Okay, what about others? Okay, I got 3 answers only. When you don't answer, it's very difficult. Right? Okay, now then current ratio, acid test. These are the things I showed: cash, marketable security, account receivable, and current notes receivable. Right. Then I have other thing. Then the other ratios are called efficiency ratios. Right? Efficiency ratios. First one is inventory turnover. Right? That is calculated by cost of sales divided by average inventory. Cost of sales or direct cost divided by average inventory. Okay, this will say like 5 times. Example times. Right, 5 times. That means per annum you convert your inventory to sale 5 times. We say it's 6 times. That means every 60 days you convert sales into inventory into a sale, right? Per annum, you are converting 6 times your inventory into sales. The same way we can calculate inventory turnover period, right? That is equal to average inventory divided by cost of sales into 365, which is equal to 60 days, right? 365. The same thing inverted, average inventory goes up, cost of sales comes down and multiply by 365. That
Sir, we can't see what you are writing actually.
okay, sorry, just hold on. I'm not sure. Sorry. Can you see now?
Yes, sir. Yes,
Right?
now we can see.
Okay, sorry, I have not shared the screen. Right, so this is like first what we did is the current assets and the current liabilities. That is the liquidity ratios. Is part of liquidity ratios, we have efficiency ratios, right? First efficiency ratio is to deal with inventory. How fast you convert your inventory into sales, right? Inventory turnover, cost of sales divided by average inventory. Cost of sales comes from P&L, inventory comes from balance sheet. Therefore, in order to avoid the timing difference, we take average figures from balance sheet and the same figures from the P&L. So we say when you do this, your figure comes as 6 times. That means annually you convert your inventory 6 times into sales, right? Then the same way you can calculate something called inventory turnover period. That is inverse of the inventory turnover, that is average inventory comes up, cost of sales goes down and to 365, which is 60 days. That means every 60 days you convert your inventory into sales. You need 60 days to convert your inventory into sales, right? If the number of days reduces, smaller the number of days, better the efficiency. Larger the number of times, better the efficiency. Instead of 6, if it is 12, that means every month time you convert your inventory into sales. 30 days or 15 days, every 15 days you convert inventory into sales. So that is better. You are not holding your cash in inventory. Always you convert it to sales and sale goes to debtors, debtor collected and cash, right? That is the first efficiency ratio. Is it clear? Is it clear?
Clear, sir.
Okay. Then we'll go to the other efficiency ratio. Debtors turnover, that is equal to credit sales divided by average debtors. This is equal to X times, right? That is per annum, how many times you collect your debtors. same way, if it is 6 times, that means 6 times you collect your debtors per annum. Then the same thing you can write in days. Debtors collection or turnover period. Collection or turnover, whatever you write, period. That is equal to average debtors divided by credit sales into 365. In this case, it is 60 days, right? That means on average, how many days it takes you to collect your credit sales. Debtor collection period or debtor turnover period. So it indicates how good your debtors are. You sell and you fast collect. So number of days, if it is low, that is better efficient. If the times if it is high, it is better efficient. Instead of 6, if it is 10, that is better. Instead of 60, if it is 30, that is better. If your debtors are stagnated, it is very difficult to collect debtors, then your number of days increases. Right? Any question on this ratio? Any question? What are you? My chat box is open. You can say yes, no, whatever. If it is not clear, please let me know. Otherwise, I'm just talking here only.
Clear, sir.
Okay. Right. Right. So we have the debtor turnover. Then we have, similarly, we have creditors payment or settlement. That is equal to cost of sales divided by average creditors. Again, it is, if it is 6 times, that means per annum, how many times you pay your creditors. Creditors payment period. That is equal to average creditors divided by cost of sales into 365 is 60 days. Right? On average, how many days you take to settle your creditors? Normally, all other ratios, if the number of days goes up, that is better. Number of days comes down, that is better. But in this ratio, if the number of days goes up, that is better. That means you are utilizing your creditors. You are delaying your payment, so you have enough cash in your business. Right? But delaying unduly will create a bad impression, reputation risk. You will not get your raw material. Therefore, this figure has to be reasonable and market in par with the market. If someone gives you goods and you don't pay, you take 180, 200 days to pay, that means you will have a bad name in the market. First instance, they can stop paying, giving you goods, they will stop, right? So that's the first thing. Other thing, When you are taking longer period, raw material will come with a premium. So your cost of sales will go up, right? So normally we take cost of sales, but if you have purchasing purchasing cost, you can use that, right? Based on the information they have given, you have to calculate this. Because use of cost of sales, so purchasing, there will be 1 or 2 days difference because cost of sales adds labor, electricity and those things, but raw material cost is the highest cost in any P&L. Therefore, this will have only a slighter effect, right? So these things are the liquidity ratios, right? I'll show you the handout. Account receivables, sales on account, trade sales, average account receivable, this plus this divided by 2. The ratio is measure how many times a company converts its receivable into cash every year. Account receivable turnover, that one inverse and 365, 13.6 days. Measure on average how many days it takes to collect an account receivable. Inventory turnover we discussed. Now we go to equity part. Equity or long-term solvency, right? Net operating income, net sales, interest. This is the balance sheet side. Ratio is stockholders equity to equity ratio, stockholders equity to total assets. This one, beginning of the year, this is the position. End of the year, this is the position, right? This one. Total assets is this one. So when you are calculating this ratio, right? Look at it. They have taken only the end figure. Why is that? These both figures are coming from the balance sheet only, right? Therefore, you take the figures as it is. Earlier we took balance sheet figures and P&L figures both together. That's why we use the figures from P&L as it is, balance sheet average, because two different time spans. Here it is as at date. Therefore, equity ratio is worked out based on stockholders' equity at the shareholders' equity at the end of the period. That is the net worth divided by total asset. That shows what is the portion of total assets funded by equity. Measure the portion of total asset provided by the shareholders, right? So this ratio can be written in different ways, right? It can be written, so it is like this. Share capital reserves, net worth, but this is X. Term loan leases, this is Y. Total capital, this is asset, right? But we did equity X divided by Z, right? We can write the same thing as Y divided by Z. That is, what is the portion of your capital funded through long term? Or you can write X divided by Y. That gives us 30:1. Sorry, 3:1. Not 30, it's 3:1. That means for rupee of debt, 3 rupees from equity. 60, we got 60% here. That means for out of 100 rupees, 60% is it is 100 from each 1 rupee, 60 cents is from equity. So you can write it in any way. This shows out of the total capital, how much is equity. This shows total capital, how much is debt. This shows per rupee of debt, what is the owner's capital. So this portion of ratios shows you the investment by the owners, right? It shows you the commitment. It shows you the, like, larger the equity, financial stress is low. That means the payments you have to make to outside is low. Financial risk is low when equity is high. When debt portion is high, that means whatever you are earning, larger portion goes to settle the long-term debt. So that is not a good sign, right? So these are liquidity ratio. Liquidity ratios talk about the capital structure. That means equity capital and the debt capital. So we discussed liquidity ratios, which deals with working capital portion, which is the current assets and the current liabilities, right? Within liquidity, we have the efficiency ratios, which are the number of days, how the current assets and current liabilities are managed. Right? Then we came to this part, which is the solvency, which deals with the capital of the business. How the equity capital and debt capital operates in the business. Now we go to the profitability ratios. Profitability ratios are calculated using the P&L, right? GP divided by turnover into 100, GP margin. PBID divided by turnover into 100, PBID margin. OP divided by turnover into 100, operating profit margin. Net profit divided by 100, it is a net profit margin. PBT margin is PBT divided by turnover. So all these are profitability ratios, how profitable the company is, right? Then you have something called ROE, that is net profit divided by average equity. Right? What is the return on equity? Profit after tax divided by equity. So ROE also a profitability ratio. These are income statement ratios. Then return on equity, ROE, net income divided by average common stockholders equity. This is the average one, right? Net income. Stockholders equity, beginning it was 180,000. End of the year it is 234. Net income is 53. Right? Net income is 53. So ROE is 53 divided by beginning equity position, closing equity position divided by 2. So you have a return of 25.9%. Right? Important measure of the income producing ability of a company. What is the return on your equity? Then comes to the market share. Right? These are the market ratios, which is calculate only for listed companies. Right? First one is earning per share, EPS. Right? EPS is calculated based on earning available to common stockholders. That is, if you declare dividends, that is the dividends part. If you don't declare dividends, then it is the net profit part. 100% declared. Right? Earnings available to common stockholders, 53. Then it is divided by the number of shares, average number of shares. Right? Earlier we divided by equity. This is number of shares. Per share, what is the profit? Per share. This one. Earlier it is for the equity invested in the business, what is the profit? Right? EPS is earnings available to common stockholders divided by weighted average number of common share outstanding. Right? The second one and the last one is price earning ratio, PE ratio. That is market price of a share divided by earning per share. Current share price divided by earning per share. Like earning is this much, you have 20%, that is 8 times higher. Your capital gain is 8 times higher. You have a much better price in the market. Right? So these are the ratios normally we use. So you have to be thorough with working capital ratios, then profitability ratios, solvency ratios. This one we use only for listed companies. Up to now, all the questions had been asked from working capital cycle, then profitability, solvency, those parts. Right? So it is summary of financial ratio cells evaluate performance as we discussed, how liquid the company is, how efficient the company is, then how the financial structure of the company is. So evaluate the performance, structural analysis, show the connection between activities and the performance. Collection and the performance is data collection. If your collection process is bad, you will have bad debtors. So your debtor position will go up. Aging will happen. Benchmark with past. Last year, your debtor collection period is 30 days. Now it is 60 days. That means your debtor position has gone up. That is a bad side. Then you need to know why. Whether your sales strategy has changed or is it difficult to collect from the market. Then you can compare these figures with other companies in the similar industry. Ratio, when you are ratios, size difference will not come into play. Limitations of ratios. Actual ratios we don't know. Market available information may not be the actual ones, right? And again, whatever the figures we use, it is old data. We are talking about last year's data or last few months data. Then seasonality effect, like December season, you take accounts and do the ratios. It is a season, so everything will be high. But when it comes to March, figures may be different. So you can't compare. So seasonality effect will have an impact on the ratios. Ratios and forecasting common stock valuation based on expected cash flows and ROE. So it is future is expected base. Showing where the firm is now. Provide context to the, like when you are doing the evaluation, you have to check the past and predict the future. Without knowing the past, you can't predict, right? So always it has to be a trend. Last 3 years, turnover has come down. Suddenly you talk about turnover going up, right? Then you have to have a proper strategy for that. You just can't predict turnover going up, right? Current information influence expectation, showing the developments that will alter further performance. Like if you have your raw material prices going up, so your gross profit margin coming down, so you can't have a better position in the future. If you are predicting GP margin to go up, you have to say why it is. There's a question for you. Current ratio is a measure of liquidity that is computed by dividing total assets by total liabilities. Is it correct? Is it correct? Current ratio is calculated by dividing total assets by total liability. Yes, no? Can I know everyone's view?
Yes, sir.
Total assets divided by total liabilities. Is it correct or no? It is current assets, current ratio is calculated current assets divided by current liabilities. Thank you for the answer. All correct. Everyone said no. Right. Then the second question. Quick assets are defined as cash, marketable securities, and net receivables. Is it correct? Quick assets, cash, marketable securities.
No.
Quick assets, it is the liquid assets, excluding inventory. So marketable securities, cash, note receivable, debtors are quick assets. Right? Be careful. So enough for today. Okay, I'm done with the ratios today. If you have any questions, I'm happy to answer you.
Sir, what is the answer for second one?
It is correct.
Correct.
Because quick assets is the debtors, marketable securities, and cash. Right? Current assets include those things plus inventory. So inventory is the hardest to convert to cash. So when you are working out the acid test or the quick ratio, you take out the inventory and leave only the quick assets. Any questions? Anything you want? Remember what I told you about the gross profit margin. Many people miss that. When you are evaluating, it is very important point. Year on year, gross profit does not change much. Why it is? Because we can pass the increase in these three to the customer from the price there, right? But there are two instances where gross profit margin changes heavily. That is when the product mix, this one, changes. This year we sell TVs, last year we sold refrigerators. Margins are totally different. So GP can change. If there is no product mix change, this will not happen. Or owner management can decide, even though prices went up, cost went up, we are not passing to the customers in order to be competitive or as a killer strategy. So customers will come to us and the competitors will be wiped out. That can happen. So that is a killer strategy. Only in that two instances, we can have a drastical change. Otherwise, it is normal changes. Right? I'm done. If you want anything, I can answer. Otherwise, thank you.